Hi everyone, it's Mark here at Teslary, and Tesla closed red today. I mean, it's not too surprising, a little bit of a profit taking going on, and it kind of respected the areas of interest if it was going to sell off a little bit. So it's down to $267.48, which is $6.10 down per share from yesterday's close. In percentage terms, it's 2.23%. We were thinking that if it was going to sell off, there was kind of two scenarios where it would find a support at 269, the 270 area, or maybe get down to 266. And it was more of the second scenario where there was a small pump in the morning giving people a really great opportunity to add some hedges in going into CPI. I think you kind of have to take those when you can get them, where you see a little bit of move, and we'll kind of measure it out. Like, what do you think this move looks like? And just roughly, maybe 1.8%. That was all we're going to get. I was thinking that we'd be more threatening to the 280 area, but seeing that we were putting in some, encountering some resistance in the morning, I managed to get in one call sold and one put bought, and that was at around $276 a share. I didn't get like a perfect 278 entry, but just wanted something going in into Friday because I wanted to add some hedges because I didn't want to buy them yesterday. I wanted to kind of get in today, not pay the theta burn, and maybe get a better entry. And I kind of did, but with the volatility not being so impressive on the stock as it was selling off, the gain was there. I think it was something like, I want to say it was something like 80%, but there was some profit. I kept it on because I'm just going to let it expire worthless, or if it gets in the money, that would be really unfortunate. But at least we have a little bit more hedging to our position going into CPI. Now, there's really not much to talk about when it comes to news. There was a large kind of suppression of price action, or really just some tickers going green just because Apple's event was going on today. I'm not a huge Apple follower. I, of course, I've always used iPhones, but I really don't care too much about the product enough to hold shares or invest in the company. I thought the presentation was fine. I think there's some cool things with the whole, gesturing with your finger to, activate or replace the function of the main button on the phone. That's cool. 3D video recording on the Pro phones. I think the gesturing was for the watch, and the 3D recording for the Pro phones, titanium finish, all that's very cool. I get it completely, but it's not that innovative, I guess. It's not like you have people camping out in front of Apple stores to purchase the latest phone like it was like maybe 10 years ago. But of course, I'm still going to always own iPhones. And, but due to maybe what could be a little bit lackluster, the market started selling off towards the end of the presentation. And Tesla was victim to that too. I think if there was some support from some good news from that event, I bet we would have closed around the 269 area instead of the 267. I think it was trying to form that base on our first dotted pink line, which we thought was going to be one of the levels to respect, but it went down and almost got down to the second one. Now, we had a big day yesterday, obviously, so a small pullback, that I think is relatively quote-unquote healthy. Like, no one wants it, but it's not too surprising. And I just wanted to prepare you for that. Giving you the opportunity to see that more of my levels are below instead of above. But we have the opportunity to have maybe a great CPI print going tomorrow, and that we can maybe test what I think is going to be a short-term resistance, which is going to be the bottom of the gap from earnings. So we're getting close to, where we're at. There was a decent recovery. It took a long time. How long did it take from us to get from the earnings date? It's like 1.5 months, something like that. It's been 55 days. So 55 days since we sold off severely based off maybe margin compression from quarter two. So we're getting set up for CPI to either be kind of not making a new high and appearing bearish on Tesla if it was to sell off tomorrow, or giving us the opportunity to fill a gap to the upside. What would that look like? If we were to fill a gap to the upside, what would that, not fill the gap, get to the bottom of the gap, just be conservative. 5% move. Tesla's done 7% moves even the past couple of weeks, so that's very possible that you can probably get to there. Maybe if you see a move really early in the morning, that I can just kind of keep the green line maybe and just move it over. that if you can get close to 280, that could be maybe another opportunity to take profit on some type of play that you have, or hedge going into PPI, going to end of the week, and going to what would be a very large options expiration. So this Friday is going to be OPEX for September, where we've seen how the action plays out on OPEX, right? It's always going to be really favoring whatever the max pain is going to be set up based off the next 2 trading days for CPI, PPI. So it's almost like you want to watch where the SPX options are being kind of positioned, or where the interest is really on those options. Follow the SPY and the QQQ, but SPY and SPX probably going to be the most heavily watched, the most important. And of course, the Tesla max pain is going to be relatively important for us. Though, due to having a really strong move on the beginning of the week, which was Monday, the options are kind of saying, okay, the max pain is around $230, $240 a share. So we've seen it get back to EM last week, right? And that, though it's kind of painful to see it sell off towards the end of the week after having an okay week, we can't be surprised if similar action was to happen this week on Friday. Just keep that in mind. Like if we're remaining outside of 265, I guess, to the upside, if we're not back within that, I think that's going to be kind of a magnet, more so than what the current max pain would be, maybe 230. We only see 230 if inflation is really, really bad, and 230 would only be the beginning. If inflation is really bad, as far as like the core CPI being higher than consensus, 230 is going to be a cakewalk. You're going to see, firstly, obviously a gap fill, and you'll probably see by the end of the week getting to like down to here, like 230, 220. That'll be not a huge issue. And if you want to know what that looks like as far as percentage wise goes, to get to 230, to get back to this kind of range and consolidation from a couple weeks ago, that would be a 14% move. 14% move over a span of 3 days. It's about 4.5% a day. That's pretty doable. That's pretty doable for Tesla. So let's hope that doesn't happen. What you can do is just kind of hedge for that possibility where going into CPI, let's say CPI has a strong pump in the morning. I mean, it wouldn't hurt to add in another hedge if that's going to be, if you're really overweight Tesla. It doesn't make sense not to be hedged just because we've seen CPI reverses over the past past year or so being actually pretty prevalent. I think the most infamous one was maybe the December one of last year, where it looked like we had a good print and it sold off completely, and it kept selling actually until the end of the year, and we didn't find a base until January. So that's something just to be aware of, that these moves can be reversed very quickly, and we've seen it happen with Tesla just even on an intraday basis on any regular old day. I think until we get all clear with inflation being just substantially lower than consensus, I think when you see that, I think we can maybe feel a little bit more at ease on a long-term basis for interest rate sensitive stocks like Tesla. The possibility of a sell-off happening on a good CPI print would be like if headline is a little bit lower than consensus, but core is in line. That's maybe you see some positivity right at the open, but having a core be in line is not something we really want. Everyone's expecting higher headline. Headline beat would be okay, but you really need to see a core, I think a miss, basically a core miss, basically lower than consensus. That's what everyone's paying attention to. We know that over the past couple months that energy costs have went up a lot, and that could really affect inflation overall. But core is really important. Seeing services come in, seeing shelter costs come down, that's going to be a sign that long term you're in a position to see a cap on interest rate hikes and cuts maybe by the beginning of the next year, sans some type of recessionary event, be it high unemployment out of nowhere or some type of credit event, companies going bankrupt or something like that. So let's look at the larger time frame for Tesla, just to make sure that everything as far as indicators looks pretty decent. From a RSI perspective, we're kind of in the middle. There's nothing too impressive there. Stochastic, it's not really that important because that can be overbought for very long periods of time. And we're still above the average we're basically still crossed over on the MACD. And like always, I remind people on a monthly time frame, that cross on our crossover on MACD is a very rare event that we haven't seen in 4 years or so. And when it does happen, it can stay above it for quite a long time. But we need a couple of good closes to keep this going in our favor instead of curling back down. And that's going to be really dependent on CPI. And if you look at the indices, we can go to the indices real quick. And you can see how, unfortunately, based off the 20 EMA, SPY closed above it yesterday, but closed below it today, just barely by a couple cents. So that's not really a good sign. You really need to get out of this situation within like 2 days or so. Like, you don't want to stay below the 20, because when you do, if you're staying below it for like a couple days, it's fine if you can break out and it won't be too bad of a scenario. But if you're under it for 2 or 3 days, you can see how it's very unforgiving, and it could be a technical indicator or a signal to algorithmic type of trading, that it's just going to be a sell regardless of whatever outcomes are for CPI, unless it's just so convincing. But you're noticing if you put the 20 on your chart for the major index, you really need to get out of it within a couple of days. Otherwise, you sell for quite a while, and you can sell for weeks. You can sell for 2 weeks, and we don't really want to be in that position. Everyone's looking at what? Everyone's looking at a possible kind of angled neckline head and shoulders. A lot of people said this was invalidated after we got above the 444 area and kind of made that not really a higher high, but a significant high compared to the peaks of the left shoulder. But I would say that it's definitely still in play until you get maybe get a gap fill to the upside, but that could take a while. Unless the CPI print's really good. So from a technical aspect, it is kind of precarious for the S&P 500. We don't want to draw a head and shoulders type of situation any further, but the market was pretty interesting today. It was a gap fill to the upside, because since we gapped down, it filled the gap, completely sold off, filled the gap from 2 days ago. So it's kind of putting us in a position that it's kind of cleaning up the chart for the short term. Maybe it's going to get into a move to the upside, because we're not necessarily making significant lows, but if you just want to look at some type of pattern, like maybe this is actually going to be a bear flag on the S&P 500, to something just to keep in mind, because I just want to give you guys that opportunity. Maybe if you wanted to, you wake up in the morning, it's 4 o'clock in the morning, or sorry, 7 o'clock Eastern time. Maybe you can trade futures. Maybe you can be awake early enough to buy some type of inverse type of ETF. That is not financial advice, of course. I would say do your own research to think if that's best for your situation. But given the opportunity to hedge a little bit, if you haven't done it so far, there could be reasons where the market wouldn't respond well to whatever comes out tomorrow. So just keep that in mind. September, of course, is the weakest month historically in the market. I would say something over 50% of the time, it's negative by the end of the month. But we've seen some early on front-loaded negativity in the market. So maybe that's going to be helpful for getting maybe a little rally that you can get positioned for a later sell-off in the end of the month. Like, let's say we go up a couple percent by the end of the week, then hedging would probably be really easy, right? Like if you were saying to yourself, I just want to let it run into PPI, let it run to the end of the week. It may be because Friday, the buybacks blackout begin for a lot of companies. Currently, we're not having any Fed speakers for the week just because it's their blackout, because what happens next week? FOMC, right? So don't be surprised as we get closer to FOMC where you see more choppiness. So if you get a move up through this week, could be your that opportunity to get ready for FOMC, because maybe the market's going to beat you to the punch and sell it off Monday and Tuesday, and you don't have that great entry for a short if something was to go bad. I would also just want to add, this FOMC is kind of being telegraphed as very much a non news event, meaning that it's just going to be a pause based off whatever inflationary like report that we've gotten so far for the past couple months, and the weakness kind of in the jobs market that we've seen from higher unemployment out of nowhere, 0.3% month over month, less job openings by hundreds of thousands, and weak payrolls. So September might be like in the books already as a pause. Guidance might be very vague again from FOMC, but it doesn't mean the market doesn't want to de-risk going into that, depending on whatever happens the rest of this week. How about let's look at some other indices. This is going to be the QQQ, which represents the Nasdaq. Nasdaq is actually okay. It was a pretty bad day today, just because the weighting of mega cap stocks that were selling off. The close was still fine above all this moving averages on the daily time frame. These are EMAs. 20, 50, 100, and 200, and it's above all of them still. And yeah, it's like right on the edge of the 20, but it's not like the S&P 500. You can look at the Russell. The Russell's below all of its moving averages again, and that's maybe typical just because for the Russell being exposed to these type of stocks going into an inflation report, maybe not so great. We've seen interest rates be pretty high on treasuries, the bonds. The yields are just kind of out of control. But the Russell is completely always will be oversold for a very long time, looking to kind of complete its own head and shoulders pattern on the daily time frame. It's actually at its neckline very soon, within 1 or 2%. It can threaten that. Getting down to the neckline is not a good look. Usually it's going to sell quickly. And you can see evidence in the past of how it threatens necklines on pseudo-looking head and shoulders over the past couple months. It's not a great look, and the sells are, like I said, just very violent and very quick. As far as, to a downside, like you might not even find a base until 175, something like that, which would be a pretty far drop of 4.8%, which the Russell can do that in about 2 days on some bad news. So even if you want to hedge, Russell could be a hedge if you think that the market's going to sell off. Because sometimes you want to have a hedge that's not just Tesla hedges, because what if Tesla has a slight outperformance, basically not underperforming as much when things are selling off? That could be a way for you to hedge a little bit more effectively, maybe even taking advantage of the weakness in the market as almost like a trade to actually just get a little bit of profit on the books. Another thing is that when CPI is on a Wednesday, right, you don't have the maximum volatility hedging with Tesla, unless Tesla moves down like 5% and the index only moves down 1 or 2%. If you have like 1 or 2 day to expiration options going into an event, and the event is very, very nasty, you can definitely get more for your investment with a shorter dated option, like things that expire tomorrow or Thursday. You can also do that on a 0 day to expiration basis, where if you see, you can even just like before the print comes out, let's say it's like 8:25 a.m. Eastern time, putting an order in for a hedge, that would be like you want a downside hedge. So you maybe are trading SPX, maybe you put an order in for a put, but the put is currently worth maybe like 50 cents. But maybe a violent move upwards could get that put down to like 20 cents. In buying a put, setting up an order for a hedge that's cheaper than what it's currently priced, hoping for a violent move to the upside that's maybe really quick, and you can maybe take advantage of getting hedges in like that if you're going to be quick enough to do it. So we talked about yields. It's really interesting, TLT, which represents the long bonds. We're talking like the 20 or 30s. It had a decent day today. It sold off a little bit in the after hours, but it was up over 0.5% on the day. And it's kind of interesting because you're seeing how the yields on the 2 and the 10 are very, very, very scary looking, because they keep pressing against a level, right? They keep pressing upwards against a level. Now that could be eventually exhausted, but looking at the 2 here, it's not like it's making any lower lows. Actually, it's making higher lows, even though the highs are being respected a couple touches already. Having another touch to the upside over 5.1%, kiss the stock market goodbye. That's something you can watch as we go into the print tomorrow. How are yields reacting? You can see on the 10-year how we thought that it could kind of print a head and shoulders type of pattern. It's still kind of in that area, but what it's really doing is just, it's really trying to, what could be really flag into a strong upwards thrust over to maybe 4.4, maybe 4.45%, like kind of up here. And that would be a pretty drastic move to the upside. The thing about it, everyone's looking at it. Everyone's thinking that yields are, a little too low in some, an analyst's perspective, especially those who happen to be on CNBC. But yeah, so it's possible that the yields can be really a telltale sign of the type of movement that the market wants. Or if you see a nice pullback in yield tomorrow, that's going to be great for the stock market. And this is something you can watch pre-market so you can, as you're waiting for the print to come out, if you have time to do so, watch yields, watch the dollar, of course, watch the futures market as well. But yields, not, you can hope that these are just like a local double top, but this is also just be really, really aggressive kind of flagging action that would move it to the upside, which would be, like I said, bad for all stocks. Really, really bad for all stocks. Now, there's not really any relevant, in my mind, Tesla news that affected the price action today. So I really don't have much to share for you. I really think this is symptomatic of a move that was influenced by a very large name in Apple that was selling off and caused basically everything to sell off, really. And it wasn't really timed well. It wasn't Apple's fault, but having the event before CPI when there's already a natural de-risking kind of thing that goes on with CPI, unless there is a lot of selling going into CPI, there would have to be some type of de-risk, right? And it kind of happened today at the open. Maybe a little bit of exuberance to get in some more cheaper puts, kind of amping people up for the Apple event, only to sell it off after they got all their puts in. Very classic kind of Wall Street type of action. You have to use those opportunities when you're seeing something fill a gap and it starts to kind of find resistance. It makes sense that that's where you want to maybe get your hedge in. I think when the gap was filled, I bought 2 puts for SPY for the 14th. I closed one out since it went up like 100, maybe 90%, something like that. So basically it's a free hedge going into what could be a violent day tomorrow. But as far as Tesla goes, before we switch to the one piece of news I want to talk about, which is just CPI expectations, the upside, upside is wherever. Hopefully you have an upside hedge, basically any type of call that's short dated that can take advantage of a sharp move that could kind of close out the rest of your downside hedges, be it calls or your puts or something like that, or at least counter losses in puts. If you have something that is like a 290 call or on something like a Tesla, if upside move going to the bottom side of the gap, that would be a very nice play for you. That would be a multi-bagger, I'm sure, if you're long in that respect. But I only like to be long only as a way to either like make sure that if there's a violent move to the upside, that I don't get all my shares called away because I just have a bunch of calls sold and they're not being actively managed like we discussed yesterday. To the downside, getting closes below the gap, which would be 260 and below, that would really suck, And the thing about it is we can talk about, what levels to watch tomorrow. Here's the reality. If CPI is bad, headline is bad, if core is bad and it starts selling, it's just going to sell, right? The type of level you want to respect is that, okay, maybe it finds a base at 260, but that's just for the day. Just know that it's going to, PPI, I don't know if could save a really bad CPI print, right? Unless it's some amazing deflation on PPI that you just know that the government has to make a hard decision, or the Fed has to make a hard decision on what to do about rates. If Tesla starts selling, you just need to say to yourself, I need to be really proactive here, get in front of this as much as I can, even though it's selling off. What do I do? Do you think that it's eventually going to start recovering completely the losses based off a really high inflation print? Or do you think it's going to get to the gap, find a couple seconds of support and fall through and reverse the move entirely? Have we seen that before? We've 100% seen it before. And I hate to be really pessimistic all the time. I just want you guys to understand that you're always long already. If you hold shares, you're long. Congratulations. If it goes up, you're winning. But if you have no downside protection in a market that's proven to be really choppy, that on a long time frame has proven this stock has gone nowhere, and you're just kind of waiting for that moment. You go back in time and you see okay, there's a period of time in the 2010s, Tesla stock goes nowhere for 5 years, and do you want to say to yourself, hey, I those 5 years, they played out for me very well. The market, it went up and outperformed Tesla for a while, but eventually Tesla really came through. But you have to understand is that you missed out on, you're admitting that you're missing out on the opportunities when things were going up and you weren't going up. At least why don't you just prevent the downside a little bit? Because that way you can say to yourself, I'm matching the market. Because if you go back a couple of years, Tesla has underperformed some indices in some ways depending on the time frame. And that's not a good look for a company that's a mega cap name making up a top 7 position in the major indices. It doesn't make sense, right? And you can almost say that's okay when Tesla's kind of in this startup phase, right? Where they're barely making it, they're almost going bankrupt, kind of like a real startup. But Tesla's not a startup anymore. They have tens of billions of dollars in cash. They have much. They have how many different streams of revenue? They're making money. So the type of move that you're looking for, if you believe that the valuation on Tesla was currently around 800 billion right now. Let's say you think it's $2 billion. And let's say that $2 billion valuation is a 1 year time frame for you. So by the end of next year, you believe the valuation of Tesla would be about 2.5 times what it is now. Maybe from the share perspective, let's just say that's $700 a share, just for the heck of it, just for easy number. Let's say it's $700 a share, and it goes up over 2 times, almost to 3 times its current value. Do you think that the reason why it went up wouldn't be the reason why some type of adjacent name or a similar business wouldn't go up kind of in the same way? Do you think that if Tesla is at $700 a share, that Rivian would be at $10 a share? Or do you think Rivian would be at $80 a share? $100 a share? Because what if if in the most optimal scenario for yourself, and you're thinking that Tesla's going to go up, Ford and GM and Stellantis, BMW, they're all going to go bankrupt, Toyota will go bankrupt, they're all going to go bankrupt. But who are the people that, could survive that transition into EV? Would it be Rivian and Tesla maybe? Maybe BYD if you're looking at it from an international perspective? I can't think of any European manufacturer that survives. But do you think Rivian will go up more than Tesla? Maybe. Do you think that semiconductors, after we get out of this high interest rate era, that semiconductors won't perform really, really well too? Do you think that AMD is going to sit on the sidelines forever and not be an AI player? Who knows? But I just want you guys to kind of think that it's nice to be all in Tesla. I'm telling you guys, I promise you, 95% of my holdings are just all Tesla stock. I promise. My wife, Tesla stock. Okay, that's how it is. Except for her retirement, which is of course being just in shares of her employer. But I'm all in that respect. Just know that you kind of look around at the other tickers, and you see movement sometimes where you're I'm not saying that we should be jealous and desire and covet something else that's happening out in the market, and I'm not saying diversification is even the best way to invest. I think a lot of really, really intelligent investors have proven and have said that diversification is just, a hedge against your own stupidity or something like that. But anyways, I just want you guys to be aware. The risk. There's always risk when you're just so heavily in one name. Let's go over to Twitter and take a look at Nick Timoros's. He just compiled an easy graph that we can reference going into tomorrow, so you can make a quick decision depending on how you see inflation compared to consensus. So here are the forecasts for all the big players, the analysts and the big banks going into August's CPI report. Nick says Wall Street forecasters expect August CPI to show headline index rose 0.6 in July, boosting the 12-month rate to 3.6 from 3.2. So like I mentioned in my YouTube short, when it comes to headline, just, understand that we all are expecting headline to be higher than what we'd like from a month-to-month perspective. But at the same time, that is expected. If that is just kind of how it is. Now, if it comes in at 0.8, right, maybe that's not great. Any type of beat on inflation is going to be bad, right? Any type of miss is going to be great. But the miss that we really care about is going to be core. Nick goes on to say they see core CPI up 0.2%, lowering the 12-month rate to 4.3% from 4.7% in July. So if you see, that's what the market really needs to see. From it's kind of like annualized rate. This is going to be a drop from 4.7 to 4.3, expecting core to just rise on a month-over-month basis about 0.1 to 0.2%, and they're kind of all over the place. But there's generally a 0.2% consensus, which is a year-over-year 4.3. What are you looking for? I would say you get a 4.2 on this bad boy tomorrow. If you only get a 0.10 on a month-over-month on core CPI, I think that is something to celebrate. I think as the market would look at that is something to celebrate. You get a 0.23 if you get a 4.4 on a year-on-year. I mean, it's over. It's over, right? Like headline, yeah, just missing on headline would be great. That a type of headline miss that would be really substantial is about a little over half of what they're expecting. 0.4. It would need to be kind of a big move that would kind of reflect in the core CPI as well. 3.5, 3.4 year on year would be a nice way to start or continue Tesla's rally. But looking at these numbers, so you're kind of prepared for yourself on a year over year, 3.6 for headline, 4.3 for CPI. How does it actually come in? These moves can be really quick. So like I mentioned from earlier in this video, kind of pre-positioning an order for kind of what you want, because what do they always say? People say, oh, like the first move is fake, or they say the third move is the real move, or whatever they say. A fake move to one side can get you positioned cheaper when you want it to go the other way, right? So if let's say core comes in at 3.6 and 4.3 and headline comes in at 3.6. So basically it's all in line. And you see like the market futures go up about like 0.25% from where it was. I don't know where it's going to start. Maybe it's red already, but let's say it goes up like 0.25%. Maybe you can put an order there. And then if that first move, quote unquote, is really fake, you can get in really cheap on some type of hedge. And if it was to sell off from that point, fantastic. You got in cheap and you're making a lot of money. But let's say it's going up and you have your order, for a move to a 0.25% to the upside, and you get filled and it keeps going up. Well, number one, you got it filled cheaper. Number two, you have the opportunity to get out of it, right? Depending on how you see the action. It's just know that that move, that usually that first candle was really be like a 1 minute candle. So that's why sometimes your order has to be pre-positioned to try to take advantage of something on a really quick move. Not financial advice. You can get really hurt if you're playing some expensive options. So keep the size of the trade in mind, which is proportionate to what you're trying to protect. So if you have like 1,000 shares of Tesla, like what are you trying? You're trying to protect, like $200,000, right? So you can't fully protect $200,000 without risking a lot of money. But on a 0 day to expiration option on the SPX, maybe you get an order filled on a put on that first move up, and then the size of that order maybe it's one contract for every 100 shares you have, right? Just don't make it so that when you get into that trade and you get stopped out of it, that the loss is brutal. Just know that you're just trying to minimize the loss of value of your share, because these are just temporary losses of value. Perhaps they could be permanent, right? They could be permanent. Who knows if we're going to get back to the highs, right? We don't know that. But when you can prevent that little bit of downside that other people are not, then you're beating everybody else. I'm telling you, you don't need to keep playing to the upside all the time. When you can prevent the downside on obvious situations, you'll beat everybody else. Everyone's like in this community is like buying, calls, and it does work out occasionally, but even so, they were already long. Like you have one of the most violent, volatile, mega cap stocks like to ever exist. Like this company is $800 billion and it moves like 7% one day, down 4% another day, down another 3%, up 7%, down 5%, up 10%, down 3%. I'm like, that's not healthy, but that's you're already in something super violent. Just wanted to let you guys know. I hate sounding so pessimistic all the time, but I think it's just a way to counteract some other voices that there's a lot of super bullish people, but it really hasn't worked out on a long-term basis over the past 3 years. So I love the company. I love Elon. Just know that. All right, guys. Thanks so much, and wish us, everyone in the community, luck for CPI to come in okay tomorrow, and that will give you kind of maybe a free pass for like 4 weeks of action going into October. All right, guys. Bye.